Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Friday, everybody. I hope you've had a productive week, and I wish you all a restful weekend ahead. Let's begin with the economy. Yesterday, Thursday, the National Bureau of Statistics published a series of official data for the month of July, and even these official numbers were disappointing. For example, Goldman Sachs analysts wrote in a note soon after the release, quote, "China's July activity data pointed to a weak start to Q3." End quote. They said they expected more easing measures in the coming months as the government tried to secure its economic growth target for the full year of around 5%, but added, quote, "It may take time for the policy effects to kick in." End quote. Jason Chan, senior investment strategist at Bank of East Asia, expressed, quote, "We did not see concrete signs of economic recovery yet." End quote. Analysts have been saying this ever since China exited from its zero-COVID state almost 2 years ago. Let's move through the salient data here. Gross domestic product growth was 4.7% in the June quarter, missing expectations. According to the official data, industrial production rose 5.1% year-on-year in July, slightly missing a 5.2% increase forecast by economists polled by US-based Bloomberg, and 5.3% growth the previous month. 5.2% in July, in line with analyst forecasts, and a rise from 5% in June, and the first increase in unemployment since February. There was also a surprise slowdown in fixed asset investment to 3.6% in the first 7 months of this year. Industrial production softened slightly, even as it continued to outpace consumption. Retail sales gained 2.7% to 3.78 trillion RMB, or approximately $528 billion in July from a year earlier, compared with a market forecast for 2.6%, and was up from a 17-month low of 2% growth in the previous month. However, this rate is still well below pre-pandemic levels. In the first 7 months of this year, retail sales climbed at 3.5%, with services consumption standing out after expanding 7.2%. Chinese financial media outlet Caixin reports that an analysis of data on 28 first and second tier cities helps reveal where consumption has been weak. In China's 4 first tier cities, Beijing, Shanghai, Guangzhou and Shenzhen, year-on-year changes in retail sales, a key indicator of consumption, came in well below the nationwide 3.7% growth in the first half of 2024. In the 24 second tier cities, only 7 bet or match the nationwide growth rate. Caixin writes, quote, "Nationwide there has been a noticeable slowdown in the growth of residents' incomes, which has dragged down household consumption. Year-on-year growth of per capita consumer spending in the second quarter slowed to 5%, down from 8.3% in the previous quarter. Meanwhile, year-on-year growth of per capita residential disposable income slowed to 4.5% from 6.2%. In contrast, the gauge of residents' willingness to consume came in at 68.5% in the second quarter, up 0.3 percentage points from the same period last year. This indicates that the main drag on consumer demand is declining incomes rather than a lack of desire to spend." End quote. And Chinese companies are feeling the sting. On Thursday, China's e-commerce leader Alibaba reported revenue of 243.2 billion yuan, $34 billion in the June quarter, versus the average projection of about 249.9 billion yuan. Revenue from Taobao and Tmall, Alibaba's core platforms, dropped a surprise 1%. Science analyst Vinci Zhang expressed in a note, quote, "The spending slump in China is real. Consumers are spending less, downgrading purchases and becoming more rational. So going into the second half of the year, Alibaba and JD.com will likely continue to face challenges." End quote. Okay, finally we need to look at housing. And surprise, surprise, the sector is not looking good. According to the National Bureau of Statistics, new home prices in 70 cities fell 0.65% from July, narrowing from a 0.67% decline a month earlier, but still in contraction. Values of existing homes dropped 0.8% compared with a 0.85% slide a month earlier. Meng Xinzang, a researcher at China Index Holdings, expressed in a note, quote, The stepped-up support for the property sector has evidently lifted buyer sentiment up. In the second half of this year, home markets in Tier 1 cities are likely to improve mildly, while a selective number of Tier 2 ones may see their home markets reach a bottom. End quote. Others are less optimistic, however. As Japanese financial media outlet Nikkei Asia points out, China's home prices are down 8% from their peak in August 2021, quote, with no end to decline in sight. End quote. Meanwhile, between January and July of this year, investment in real estate nationally declined by 10.2% compared to the same period last year. Other indicators also trended downward. Newly built homes by sales volume dropped 24.3%, and overall home sales decreased by 25.9%. Meanwhile, unsold homes as of the end of July increased markedly. A gauge of Chinese developer shares have slid further into a bear market, dropping about 34% from a mid-May high. So these are the salient economic data points for July, but like we always say when we examine economic numbers, what is important is not the speed of growth, but the quality of growth. As Peking University Professor of Finance Michael Pettis expressed in a post on these data today, quote, while most analysts focused on what today's data release tells us about the strength, or rather weakness, of the economy overall, I would stress that it is more important that the quality of growth is also deteriorating. High-quality growth in the Chinese context is the share of growth that occurs under hard budget constraints, which mostly means the share of growth driven by domestic consumption and by private business investment. Not only is consumption lagging, retail sales grew by 3.5% in the first 7 months of 2024 versus 5.9% growth in industrial output, but private business investment is flat, even as fixed asset investment overall grew by 6.3%. That is a real problem. In my opinion, July data has increased the likelihood that later this year, Beijing will unleash a meaningful fiscal stimulus aimed at boosting consumption. Today's stock market performance suggests that this may no longer be such an eccentric opinion. End quote. Next up, it was confirmed yesterday that Vietnam Communist Party General Secretary Lam, who is concurrently Vietnam President, will visit China from August the 18th, this Sunday, to August the 20th. He is expected to have an audience with General Secretary Xi Jinping, who travelled to Vietnam in late 2023. UK-based Reuters, citing unnamed sources, reports that Lam is scheduled to attend next month's United Nations General Assembly in the United States and possibly to meet with President Joe Biden. The PRC Foreign Ministry spokesperson said that Lam was asked to come to Beijing at the personal invitation of Xi Jinping. Lam will also meet with Li Qiang, Zhao Leji, and Wang Huning. Despite their economic and trade links and shared communist ideology, the two nations occasionally clash over boundaries in the energy-rich South China Sea. Indeed, we have seen in recent weeks Vietnam growing closer to both Japan and the Philippines in order to counterbalance Beijing's influence and activities in the region. There is, of course, also millennia-old frictions between the two powers, not uncommon with neighbours. With this news, we should expect to see Xi Jinping back in public in the coming days. Regular viewers may remember 2 weeks ago I said Xi, with other leadership, were going to their annual Beidaihe resort trip where they discuss policy and politics in a more relaxed, private environment. During this 2 weeks, they do not appear in public. Every year, this fuels groundless speculation and claims that Xi is sick or under house arrest or something else. This year was no exception, with many rumours swirling about Xi Jinping. These rumours should be proved false in the coming days when he reappears to meet with Vietnam's General Secretary Lam. Now, we have one more update to cover, but just quickly, if you get value from China Update, don't forget to hit the like button, and subscribing is also a tremendous help. It means you're on top of these updates as they're released, and it is a good signal for the algorithm. Sharing is a big help too. It's one of the best ways to grow the channel. Patreon and Buy Me a Coffee links are also in the description for those who want to help keep the channel financially sustainable. Thank you so much, everybody, for the ongoing support. Okay, finally for today, I wanted to discuss some important updates in the car and vehicle space. On Wednesday, PRC autonomous driving company company WeRide announced that the company has received approval from the US state of California to test its driverless vehicles with passengers. A company spokesperson said that these tests will help fine-tune autonomous driving technology solutions. Conducting tests in the US will provide more reliable and accurate data and help it attract more potential investment in the US. WeRide, a $5 billion software maker developing robo-taxis, announced last week that it will launch an IPO in the United States, and it expects to raise about $96 million from this IPO. Commentators point out that due to geopolitical tensions, there has been a rush by Chinese automotive tech firms to raise money in the United States before they are banned from doing so. Veteran China analyst Bill Bishop observed on the news this week, quote, "I'm surprised WeRide would want this California testing publicized right before its IPO. The US Congress may be on vacation, but it seems like the kind of thing that will draw attention from the Hill, if not also the Biden administration, just after the embarrassing Pentagon walkback of restrictions on Hesai and reports that the Department of Commerce will soon issue restrictions around PRC-connected vehicles." End quote. Meanwhile, vehicle industry expert Michael Doon published a sharply worded, but quite convincing, commentary on his Substack called "China is Done with Global Car Makers. Thanks for Coming," in which he argues that the golden era for foreign car makers in China is likely now over and will likely never come back. China became the largest car market in the world back in 2008, and for years foreign brands made a fortune there. This in part explains why many put up with IP theft and forced joint venture requirements in order to sell to the market. This situation has changed in recent years, however. To end today, we will examine this Dune piece, which we're now quoting selected excerpts from directly. For most of the century, foreign brands totally dominated China's car market. Every year, they sold millions of cars and earned billions in profits. Chinese consumers swarmed into Buick, Volkswagen, BMW, and Toyota showrooms nationwide, happy to pay cash for the prestige of owning a brand that wasn't Chinese. China is our forever profit machine, my colleagues at GM liked to humble brag a decade ago, back when I ran GM's Indonesia operations. We can bank on an easy $2 billion dividend every year, he would tell me. Now suddenly that golden era is over. Sales and profits in the People's Republic of China are vanishing, and boards in Detroit, Wolfsburg, and Tokyo are stunned by the speed and intensity of the changes. Ford has lost more than $5 billion in China since 2020. Sales are down 70% from their peak. GM is hurting too. The former poster child for sunny US-China relations, GM has lost more than $200 million so far this year alone. This marks the first time in 2 decades that GM's China operations have printed red ink. Detroit is not alone. Almost every non-Chinese brand, German, Korean, Japanese, and French, is feeling shell-shocked as they watch their market shares disappear. Dune, the author, then moves through the main reasons for this dramatic shift. Electric takeoff. Driving China's ascendancy is a massive and abrupt shift to electric vehicles. The EV share of total car sales will jump to almost 50% this year, up from just 6% in 2020. Think about that. China has sprinted from 1 million to more than 10 million annual EV deliveries in just 4 short years. Global automakers were caught flat-footed on EVs, lured into complacency by years of winning at selling gasoline-powered vehicles. Chinese automakers, in contrast, seized on the shift to electronics. This year, 18 of the 20 best-selling EVs are Chinese brands. The other 2 are Teslas. Advanced technology. There is no secret that global automakers are finding it impossible to match Chinese competitors on costs. BYD builds cars 25 to 30% more cheaply than what global automakers can manage, thanks to extreme vertical integration, breathtaking speed, and generous subsidies from the city, provincial, and national government agencies. But this is not just a low-cost EV story. Chinese automakers now equip their cars with some of the world's most advanced autonomous and digital cockpit features. Keep an eye on tech giants like Xiaomi and Huawei, which infuse their new cars with world-class software. Strength is alarming even the mighty Toyota. In a 2023 interview with the Toyota Times, EV chief Takeru Kato recalled his shock during a business trip to China. "For the first time, I came face to face with the competitiveness of the Chinese, laying eyes on equipment that I've never seen in Japan and their state-of-the-art manufacturing. I was struck by a sense of crisis. We're in trouble." Chinese automakers tell me privately that they carry a deep respect for Elon Musk and Tesla. They tend to shrug with indifference at most of the world's other car companies. Nationalism. When it comes to cars, Chinese brands are suddenly the new cool. Global brands, once so aspirational, are now so yesterday. Nationalism is the invisible but potent force behind the shift. One day at our Beijing office in the late 1990s, I asked my ace staffer what he thought about China's joint venture arrangements with foreign companies. "It's okay for now," he said, "until we can kick your asses out of here." We are now stepping into a new era where Chinese automakers dominate their home market. Many will say that this outcome was inevitable, but no one saw it coming this fast. BYD became China's best-selling brand last year, knocking VW from its top ranking for the first time in 38 years. Chinese brands as a group are devouring market share at the expense of the once mighty foreign makes. The reality is that China, as a growth and profit paradise for global automakers, has disappeared. It will never return. Most of them will be shown the door within the next 5 years. Some will find the exits even sooner. Here ends the direct quote and today's episode of China Update. I would very much like to know what you think of this last development we covered and this article from Dune, as well as the economic data we covered in the first half of today's video. Thank you for watching today's episode. Have a good Friday, have a restful weekend, and I will see you all tomorrow.